Welcome to ActivTrades Monday Market Matters webinar for 24th of April 2023. It's Paul here. You're all very, very welcome. Hope that you can hear me well. Hope that you can see the slides as we talk about today's Monday Market Matters session, which is all about what are safe haven assets. That's kind of an interesting topic. Will appeal greatly to those of you just starting out on your trading journey, as you're just sort of grasping the whole, let's say, complexity of global international markets, and hopefully it'll give you a little bit of insight into what they are, and also how we can turn them from a threat into an opportunity. So, you're welcome. Great to have you here today, as always. As always, we look to begin with just a quick risk disclaimer. Just remember that trading on margin does involve a level of risk, and that ultimately you are responsible for your own trading decisions. So what should we talk about today? Well, as always, we'll do a little intro to Monday Market Matters and have a little look at the news coming up for the week ahead, and we'll talk about, well, what is actually a safe haven, why is it important for traders to understand them, and how can traders use them to their advantage? And that will plug into us actually having a little check on live markets as we enter the opening of the US markets into the US session, but also how we can utilize the tools and platforms provided to you by ActivTrades in order to effectively understand safe havens and how to manage them, and, as I say, turn them into an opportunity. For those of you who don't know me, my name is Paul, traded for many years, traded for funds and for clients, and primarily I tend to focus on trading FX indices and commodities in my own trading, and I tend to be a trend trader for longer term position trading, and a mean reversion and reversal trader for shorter term trading activities, both of which are relevant to today when we talk about safe haven assets and the impact they can have. For those of you joining us for the first time, Monday Market Matters is just effectively, our weekly webinar aiming to help traders start the week in the right frame as we prepare for the opening of the US markets in about 25 minutes time. So every Monday, 2 p.m. London time, what we do is we will cover a little bit about the news. All right, what is the major news to be aware of for this week ahead that's we're coming into? We'll also do a piece on education, right? A piece on building your trading knowledge in order to help you sort of improve as a trader. We'll always take a little look at what are the ActivTrades platforms and tools that you have available to you. We finish with a look at the live markets, okay, as we start into the US session. For those of you who are getting ready to sort of either, whether it be intraday traders or whether just be ready to sort of manage your positions as you go into the start of the US trading week. So, as always, there's always lots for us to cover. There's always lots for us to sort of try and pack into our hour. So, without further ado, why don't we crack on, ladies and gentlemen? Well, we always look to start with, as I said, a little bit of the news. I say every week without apology that, if you are a new trader, I don't expect you to be able to analyze the news, but I do expect you to know when it's coming out. Okay, there's no real excuse not to know when there are major pieces of economic news data coming out. You will find that there is a economic calendar on the ActivTrades website. You'll also find that there are other economic calendars available to you across the internet, and you also will have, if you sign up for it, you'll actually get an email at the start of each week from the ActivTrades research team, like this, just providing you with a little bit of a heads up on what we're going into with the week ahead. And this week is a bit of a chunky news week. There's plenty coming out. Okay, as certainly as we get into the later of the week, as we can see there, today is a little bit of a relatively quiet day, but as the week goes on, we start to get more and more data. Okay, you can see that tomorrow we'll get a little bit of the consumer confidence index and new US home sales info on Tuesday. Wednesday we'll be looking at Australian CPI figures, okay, US durable goods orders, and the Bank of China will be publishing its monetary policy minutes. When we start to sort of get interested in is, Thursday and Friday, where we're getting like the US GDP numbers, and also the home sales are expected to be published. And on Friday, what we're doing is we're getting insight into the sort of Bank of Japan, all right, in terms of their monetary policy and whether there'll be any change on that, as with the sort of the recent change of the governor of the Bank of Japan. We'll also get a fair bit of GDP data, but one of the things that will be of interest is also the US core PCE, which is kind of the personal consumer expenditure, and that's what starts to take an interest. Of course, lots of traders take an interest in the CPI data, and rightly so. and rightly so, but the PCE, it focuses more on individual consumption, and is actually what the Federal Reserve themselves take a greater interest in. So it's useful for us to see what that data is, and undoubtedly, if that data comes out different from what the forecasts are, then invariably we'll see some volatility in markets. So I expect what we will see is that markets may start off the week relatively quiet, but as we get deeper into the week and deeper into some of that bigger news, certainly coming out of those US markets, that is what will have the induce the volatility and bring some move to markets. And so, as I say, hence why it's important for new traders to know when that data is coming out. All right, always make sure that you start each week, each day, each session, just by checking the economic calendar to ensure you know what's coming, what's coming down the track for you. And as I said, this is provided by the ActivTrades research team. You'll find that they provide a great deal of fabulous information and insight on their website and through email. So be sure to check that out and be sure to avail yourself of that useful research. So let's talk a little about safe haven assets. It'd be interesting to know of the people here joining us today for the live session, what, if any, experience you have of safe havens. I do recognise that we have a broad range of experience of traders who join our sessions, from those of you at the beginning of your journey to those of you who are quite advanced intermediate traders. You're always all very welcome. There's always something for everybody here. And we also recognise that we have a truly global audience who join us. So wherever you're joining us from in the world, you're very welcome. I hope you're having a great year so far in every sense of the word. And as I said, we're here to sort of learn a little bit about the safe havens. And as the slide says, during volatile times, we hear lots of talk about safe havens, but what actually are they? Right? What actually is what makes up one? Okay, and it's important for traders to understand what safe havens are and the role that they play in markets. And in doing so, you help yourself treat them as an opportunity rather than as a threat. And in this session, that's what we'll discuss about the different types of safe havens and how you can engage with them as part of your trading. And as we switch across to the ActivTrades platforms, I'll show you how I can do that specifically for myself. Well, it's important, as I say, to understand what they are and the role that they play in markets. And as I am always sort of talking to traders is about one of the many benefits that we have as private traders is that we have the ability to effectively be nimble and agile and adaptable to markets. We have the ability to go both long and short in markets, and that allows us to effectively sort of engage with markets in a multitude of different ways. And as I said, that allows us to what might other maybe larger traders, larger size traders might treat as a threat when there's a kind of move against them. Well, that actually can be beneficial to us. That can be an opportunity because we can be agile, adaptable, nimble, all right. And so when we see markets change because there might be a flow of money into safe haven assets because of something that's gone on in the world, well, as I said, that can be something that can be turned into an opportunity for us rather than a particular threat. So, when we look at a safe haven, generally, a safe haven is deemed to be an investment that is expected to retain or increase in value during times of turbulence, and that is sometimes often overlooked by, let's say, newer traders. Is that something that might be deemed to be a safe haven is that during volatile, risky times, actually lots of traders are just happy with being able to play good defense and retain value. Okay, you might not necessarily any increase in value might be deemed as a fringe benefit, so to speak. But when times are risky and volatile, well then the ability to have an investment that retains value is unbelievably popular. And as I said, that traders and investors seek them out to limit their exposure to possible losses when markets turn downwards. That's not really a surprise. When you will have undoubtedly seen it yourself, even just in this year alone, that invariably when there are shocks to the system, whether they be intended one or whether they be unintended one, unexpected ones. So, for example, this year, we saw elements in some of those American banks, and then we saw, with the Credit Suisse Bank, and all of that has an impact on investors and traders, their confidence, their self-belief. and invariably, their tolerance for risk. And so, all of those shocks, shall we say, can have an impact on moving markets. And so we want to be able to, as I said, to effectively either, limit the downside, or, even possibly put us in a position to retain the value of what might be either our investments or, our overall portfolio. As it says there are plenty of safe havens, and it's important to understand context. Okay, not all safe havens are the same. Not all of them operate the same way, and so there is nuance between them. And so it's useful for us to be able to understand the context through which they are seen. So all traders, investors, must complete their due diligence, and that really goes without saying. Whenever you're engaging with financial markets, that you must ensure that you do your own research, do your own due diligence, and understand, what are the risks and rewards of every possible investment, every possible asset class. All right, and that is just best practice for anyone who's managing their own investments, managing their own portfolio, and as part of that, understanding safe havens and the role they could play for you can be really crucial for new traders and investors to understand. So, if you think about it as a safe haven helps us, as an investor, to diversify their portfolio, to be able to move away from what may well be, high risk either investments or high risk trades, towards ones that are deemed to be more in alignment with, let's say, the new risk sentiment, or the overall sort of environment context of that particular market. And that might happen very fast if something, there's a shock to the system, or it might happen over a slow time as effectively sentiment starts to change on whether it be an asset class or whether the overall global markets. Secondly, a safe haven should help be beneficial in times of market volatility. And, what we find, and, what I say all the time is that, even with the increase in algorithms working within markets, markets still are a reflection of human psychology. And within that, markets, we, like all humans, we surge, then we rest, then we surge again. And it can be that, that market volatility can be the sort of, the equivalent of a surge. Now, sometimes that might be able to be planned for, maybe that could be expected, maybe that can be analysed and understood. There are other times when, as I said, there might be a shock to the financial system, okay, and that basically, it provides a surge, but it's more of a volatile surge than perhaps one that might be expected and planned for. And so a safe haven might well be able to help us, during such periods of market volatility. Not unsurprisingly, during a severe market downturn, like an economic recession, then it provides a safe harbour. All right, it provides a safe harbour. That's where, as sailors would be when there was a storm out to sea. They would be more happy to be sort of sat in a safe harbour. And then market downturns, when we are working towards economic recessions or in one, well then, people and traders, investors will be looking for sort of safe havens there as a safe harbour to hold in. And that's quite relevant, I think, for present climate, as we have over the last few months, we have drifted towards a mixed analysis. Many people thinking that we will go into a recession. Okay, certainly here in the UK and perhaps in let's say the Western economies. Many people will think that. Many people will also say that we may well escape it, even if it's merely by the skin of our teeth. But nevertheless, there will be volatility that comes with that. And so traders and investors will be looking at ways and means that they can, as I say, confide their own safe harbour. Any safe haven is a safe haven that offers protection from market downswings. And, we've had considerable, market downswings in different ways. If you look at things like banking sectors, looking at particular banking stocks, we had even in some of the indices, we've had that as well. And I'm just looking there in, the last month or two in terms of a reflection of some of the challenges there within banks, both on the US banks and European banks. But, you only have to look back over, charts of any particular asset over the last few years, okay, to see that there have been times where there has been, real significant downswings in certain markets, certain assets. And it's about, well, what can I do to basically find myself a safe haven that'll offer me some sort of protection? With that in mind, let's take a little look at some examples of safe havens, different asset classes, and how they operate. And then what we'll do is we'll switch across to the ActivTrades platforms, and we'll have a little look at it, in terms of live markets, but also how you can set yourself up to be able to understand, the sort of, let's say, the overall risk profile of the market and how those safe havens are doing. When we start to see safe havens all increasing in prices, well, that in itself is giving us a bit of an indication that there might be an element of volatility, and maybe there is an element, but what might actually just be fear, a little bit of human fear in markets based upon what's actually going on, and that might be reflected in the price of certain instruments, and we can, as I said, we can utilize that as either an early warning signal or as an opportunity as a trader in itself. So we'll just, as I said, have a look at a few examples, and then we'll switch across the platforms to have a look at how we can utilize that. So not unsurprisingly, one safe haven is gold. And for years, for thousands of years, it has been considered a store of value, and even in today's digital times, where many people have written off gold as a potential store of value. The reality is that gold is deep in the human psyche in terms of being seen as valuable, and invariably there is always a demand for it, and in some ways, what is useful for people is that its value is not impacted by interest rate decisions. Now, if you are, as I said, looking for a safe haven, then that can be particularly useful. If you are looking, if you're a portfolio manager looking for yield, you're looking for return, well, then that might not necessarily be ideal for you, because actually what you're looking for is that in that particular case, you're looking for a capital appreciation rather than perhaps yield on an investment. But as I said, we're looking here as a safe haven, something that can effectively help us retain value, or at least minimize our downturns when overall markets drop themselves. And so what you'll see is that it serves as a form of insurance, and that's what it's done. And also, it's seen as a bit of as a hedge against inflation, as it's priced in US dollars. So, lots of people will utilize that, not unsurprisingly, because we've discussed in the past, pretty much all commodities are priced in US dollars. I know we've had a lot of, let's say, media speculation that it's about the end of the dollar recently, especially with some of the BRICS nations looking to effectively be able to trade commodities in their own base currencies more so than in US dollars, and I think more of that will happen. But the size and the scope of those trades is minuscule, right, when it comes to the US compared to the sort of amount of US dollars in circulation for global trade. And of course, that has an impact on that, and so gold starts to become interesting and useful to it as that hedge against that inflations. And it's true that some other commodities may act as safe havens, things like silver, etc., but they are not as strongly correlated as gold. And we'll look at the gold chart in a moment, when we switch across to the live charts, just to see how that has impacted recently. If you're an active trader and investor, you will have seen that there's been some quite interesting moves and trends in gold over the last few months, and a lot of that driven by people looking for safe havens. When people are getting worried, or people are getting nervous, when they saw things like the kind of a collapse of banks in both the US and in Switzerland. That's people are still humans. And people look for ways to hedge, and hedge their position, to look for that form of insurance. And for thousands and thousands of years, people buying gold, they have used that as a form of safe haven when people believe markets or life in general is somewhat volatile, and many would say that is what we've experienced the last couple of years. So that's gold. One of the other ways that you can use an example of a safe haven is US Treasury bills. Quite often referred to as T-bills. You will see them for those of you who are completely new to trading. Really, it's a debt security. It's a grand IOU, and that's what they're looking for. And particularly with like T-bills, which are effectively IOUs offered by the US government. And why would that be of any real relevance or interest? Well, regardless, or despite what people may think of the US and the US economic situation, the US political situation, the reality is that should there be a major catastrophic failure of the financial system, people still have a belief that the one institution that would still pay its debts or pay its bills would be the US government, mainly because the US government is, the US dollar is that reserve currency of the world, their ability to keep printing that in order to pay their bills. So invariably buying, treasury bills, IOUs from the US government, is seen as a safe way to effectively, or a safe place rather, maybe to park your money, to park your capital during times of strife, during times of risk and volatility, and that's why you'll see people keeping an eye on on terms of the price and the interest rates associated with treasury bills. Well, yeah, as I said, it's considered a safe haven in rather tumultuous times. Considered to be risk-free. I would caveat that with saying is as risk-free as anything possibly ever could be. But the belief, the belief is that they are considered to be risk-free, and that's what gives them their value of a sort. And because any principal invested, it will be repaid by the US government. People still expect the US government to be able to pay its bills because they can still print as many dollars as it needs to be to do that. And so, what you'll find is, during periods of real strife. So, for example, during the let's say the GFC, the last big great financial crash, what we saw was that lots of money got parked in treasury bills. My own view, and this is my own personal view, is that is that capital is a coward. All right, it will run and hide in the safest place at the first time of trouble. And for a lot of investors, the sort of the safest place for it to hide is to sit in treasury bills. Okay, and that's why people keep an interest in in the treasury bill market in terms of the price and the yield that's available. And as it says that during periods of economic chaos, investors run towards them. They don't walk, they run. Or as I said, I believe capital to be a coward generally, and it's a case of T-bills are seen as a safe place, a safe haven during periods of downturns. What some people might see as safe haven is also what would be termed as a defensive stocks, and so. This is where during periods of volatility or strife, or people, are worried about stock markets or, just markets in general, well, they would move their capital into stock sectors such as the utility sector, healthcare, biotechnology, etc., consumer goods. What I deem not to necessarily be terribly exciting sectors, okay, when markets are in, let's say, an aggressive, expanding, growing mode. Well, as I said, they are by their very nature defensive stocks. It's where investors will move their capital into those particular stocks and sectors, and you will find, when you look at financial media, if there is a lot of interest and focus on those particular stock sectors, that in itself is giving an indication of the overall sentiment of markets. And I'd invariably, when people are a little bit worried, people are a little bit nervous and apprehensive, well, then invariably, they will take a greater interest in things like utility, healthcare, and consumer goods, etc. Those sectors. When markets are in a, let's say, in a sort of more of a greed style, okay, where there is an appetite for risk, well, then invariably these sectors, that's when they will tend to their overall price and the price of their constituent stocks will tend to fall, right? Because the risk sentiment means is that traders and investors are looking for better opportunities with a higher yield. But when markets are struggling, when people are nervous, as I said, they're looking for a safe haven with which they can park their capital until let's say the stormy weather has passed. The reality is as it says there, consumers are still going to need to purchase food, health, health products and basic supplies even in a downturn. And that is what makes them defensive stocks, because regardless of what might go on, in financial markets or in the globe, humans still need to purchase, as I said, food, health products, and basic supplies. All right, and that is what effectively allows them to be, defensive sectors during times of strife and volatility. And not unsurprisingly, as it says, there's more investors flow into their share price holds or actually increases. It's all about very supply and demand. Okay, if there is demand for that, well, it will drive their price up, and that is what allows investors to be able to retain and perhaps maybe even increase their their portfolios during risky times. Not unsurprisingly, another one example of a safe haven is simply cash itself. As the old saying goes, when fear reigns, then cash is king. And part of that is, it is an old trading adage, but I would suggest it's also, also for businesses as well as they run. It's that, effectively, cash flow becomes ultimately important during downturns. All right, being able to ensure that you have cash flow becomes hugely important. And whilst it might also be a trading adage that cash is king, it goes for the same for business. All right, and it is a safe haven during the market downturn. Now, of course, you have to remember that cash offers no return or yield. So you will undoubtedly take some hit through to inflation, but as I said, lots of people and lots of institutions and individuals during a downturn, they're just looking to effectively to downsize, to minimize their losses as much as possible. And cash again, because it's there, all right, and they know it, and they know it's liquid, and they have access to it. Okay, they hope, and so that is what they actually look to do. So when we look at the FX markets, there are, in terms of examples of safe havens, there are one or two that spring to mind. Okay, and there's two in particular. And the first of those is the Swiss franc. And the Swiss franc is considered a safe haven currency due to the stability of the sort of the Swiss government, the financial system for various reasons, and the country generally has low unemployment and a high standard of high living, and it generally tends to have positive trade balance figures. So all of these elements are sort of, contribute towards, as I said, the Swiss franc being considered a bit of a safe haven currency. There is also some elements of it with regards to it being a tax haven as well, although that might have changed a little bit from the past, but nevertheless, it's still seen as that. There is also, a kind of a sort of implied element in terms of how it is seen its relationship with gold and how it's looked to be backed by gold, and that in itself is all contributes, as I say, towards the Swiss franc being being seen as that safe haven, and hence why what we'll often see, because when there is major volatility, whether that be due to economic news or whether that to be geopolitical tensions like we've seen, let's say, in the last year in Eastern Europe and Ukraine, well, what happens is invariably that means that the Swiss franc will look to effectively to strengthen in price. If we look even at this particular moment as I speak, due to some of the issues, as I said, with overall markets and also the issues we've had with particularly banking system, the Swiss franc has been very, very strong these last couple of months. Okay, as we talk about here in springtime 2023, for the last couple of months, as we'll look at, we'll see the Swiss franc has been very, very strong because there is demand for it, because it is seen as a safe haven currency when volatility exists in the market. And the other currency that is very often used is the Japanese yen, and the yen has been different from the Swiss franc, is that it's only been considered safe haven for the last few decades, where the Swiss franc has been considered one for a much longer time. And what we have seen is that the yen historically has performed well during periods of risk aversion, and historically it was also did well because of the carry trade, which was seen in the FX world. Okay, and the carry trade, it still continues to these days, and there's been a little bit of it, but it's perhaps not as big as it was maybe 15 years ago. So just before the GFC, the Great Financial Crash, in the sort of 2008, and a lot of that was just effectively due to the fact that because interest rates in Japan were so low, well, the carry trade invariably basically meant that you would borrow money in a low interest rate environment like the Japanese yen, where it was very often around about 0.25% in terms of the interest rate. So you would borrow money in Japanese yen, but then invariably you would put the money into, let's say, higher interest rate market environments. So there was a period there about 15 years ago where invariably the Kiwi dollar was effectively running at an interest rate of around about 8.25%. So you effectively you borrowed money in Japanese yen at 0.25%, stuck that money in the New Zealand dollar or New Zealand based bank account, okay, and take your 8.25% of interest rate, and then invariably you were still net positive to a large amount. Now if you're a very small investor doing it on a small account, that's perhaps not a massive difference, but invariably for a lot of hedge funds and institutions, okay, you're able to do that in the billions of dollars. Well, that actually became very easy and became a very nice trade. And then you also had the effect of the capital appreciation in the New Zealand dollar because of the demand in that. And so all of these things are sort of had an implication in terms of why the yen was considered a safe haven for decades, and it's still considered so. Okay, and it's still considered so. And when you just look at the overall balance of payments and the overall state of the economy, well, what we see is that Japan still owns more than it overall owes, and all of these things are deemed to be seen as beneficial during times of risk and volatility. What we also saw, and I think that number may have changed a little bit more recently, is that Japan is seen as to own over $3 trillion more in foreign assets than foreign investors own in Japanese assets. Okay, so all of that, as I said, it all adds to the kind of balance payment, all adds to being seen as how to as while Japanese yen is deemed as a safe haven currency during those particular periods and times of strife. Yeah, and so as it says, that makes it the world's #1 creditor to nation, and that is all that contributes towards money looking to flow into the Japanese yen whenever we see any particular major geopolitical or financial volatility in markets. And yeah, it actually has become that self-fulfilling prophecy. That's what we see, even when it perhaps maybe not makes terrible sense. So, for example, what we see is that, for example, one example is the North Korea in particular, whenever they test a nuclear weapon or whenever they test one of their rockets, invariably what we see is that that scares markets a little bit and gives the market a little bit of shock, and invariably we see an appreciation in the Japanese yen. Although it seems to be lost on many people that actually very often when North Korea is practicing these rocket launches, they're actually firing them in the direction of Japan out into the Pacific Ocean or the South China Seas, and so even though it perhaps Japan in many ways is the country most likely to sort of struggle with the problem due to, let's say, North Korean rocket tests. It has not, as I said, not failed that kind of self-fulfilling prophecy of when people see that they still look as an opportunity to flow capital to flow into the Japanese yen and for it to appreciate. All right, so as I said, it's become a bit of a self-fulfilling prophecy. So we've gone through a few examples then, and it's probably easy to show that in the live markets, which is what we'll switch across to in a moment's time. But just to finish up on the slides before we do. Well, yeah, it's going to be an interesting year for markets. All right, we've already seen quite a lot of volatility, quite a lot of requirements for safe haven. So hopefully you'll join us to enjoy this journey. And what will be an eventful year. As I said, every 2 p.m. London, every Monday gives you a chance to join Monday Market Matters, and we'll always go through a little bit of education, a little bit of news, and then look at what's going on in those live markets to prepare for that. What we said, is safe havens. They do offer protection from market downswings, and things like precious metals, currencies, defensive stocks, and more have been used as safe havens in the past. However, you should be aware of which safe haven is preferred for the particular crisis. And as I said, the Japanese yen is very often used, but it can be a bit of a self-fulfilling prophecy, which is both a good and a bad thing. And so, hence why I tend to look at a particular profile on the ActivTrades MetaTrader platforms, which I'll share with you in a moment to give us a little bit of insight. And as I said, if you can identify those order flows into safe havens, then it gives you some insight and it actually provides an opportunity, and that's what we'll look at in a moment's time. So, without further ado, why don't we have a little look at live markets and see, A, what safe haven's been doing, but also B, let's have a little look at the markets as they go into their opening for opening of the US session. Before we do that, just a reminder that there are bank holidays in the United Kingdom for both next week and the week after. I think we have the May bank holiday for next Monday, and then we have the bank holiday for the coronation of King Charles the week after. So there will be no Monday Market Matters webinars for the next 2 weeks. We'll return on the 15th of May, London, 2 p.m. time. And what we'll be talking about then is trading a setup, a simple trade setup called the FTR, the fail to return. And what I'll do is I'll basically share insight on what it is, how you can utilize it, and then we'll look at live markets to see how it shows up for us in trade in live markets, which is what people always like to do. So as I said, we'll be back in a couple of weeks' time. Effectively what will be three Mondays' time, on the 15th of May. I think so. Be sure to go onto the ActivTrades website and sign up, register for that particular session. As always, if you want to contact us, if you've got any questions or comments or thoughts, or if you'd like for me to look at one or two particular topics that would help you, we always welcome the feedback, and you can get in touch with us there. The English desk is on 0207 6500 567, or email us there, englishdesk@activetrades.com. So if you bear with me, what we'll do is we'll switch across to the charts and have a little look at what's been going on with the markets themselves. So just bear with me one moment and we'll switch across. Okay, so what I'm hoping that you can see you can still hear me. I'm hoping you can see the MetaTrader platform, ActivTrades MetaTrader platform. And what I have here is I have basically, this is a profile I call RORO, risk on, risk off, and it kind of links into our conversation about safe havens, all right? So what I have on here, let me move this around a bit so I can just show you. I just have, as well as my other profiles, I have a simple profile that I utilize just to give me an indication of order flows into particular safe havens to see see what's actually particularly going on based upon the platforms that I have available. So we talked about gold. So we talked about particularly gold here. And this is the gold chart here, and I'm actually just going to show how I set up and run my charts as well, so we can utilize that. This is gold, so I'm just going to change this a little bit just to basically, so it's easier to be a reminder for us. That's how I have my gold charts, and what I'm going to draw on here is just going to draw on a line there. Just let's bring this up. Yeah, here we go. Excellent. So we've talked a little bit about gold in the last couple of weeks and stuff when we've looked at charts. This is the weekly chart, of gold, and I'm hoping what you can see is that this big round number of 2,000 has been a significant level, all right, significant level for the last couple of years. Hopefully you can see that there, and it is it's a case of as we said, is that when people are fearful, people are worried about markets. Volatility, well then invariably we'll see money flow into the safe havens here, and that's what we've seen here since kind of October of last year. We can see that we had a strong bullish run there, with gold, and we had a little bit, so we had a little bit of a pullback, but as that kind of the news about issues with banking came out, well, we can see that we've had a real rally up there, real strong particular move. Ian asks a question: are there any specific order flow indicators? Thanks. That's a good question, Ian. That's a very good question. I don't particularly use order flow indicators myself. I think that actually reading price action is the strongest and the best and the quickest way. But I'll share with you one very simple idea that you could take away and utilize here, just as a very simple way of for order flow. If I just let's say I'm going to use a couple of very simple moving averages here. I'm just going to put that in. I'm going to use a 9-period exponential moving average. Let's just make this a bit different, right? Bit different. A 9-period, and then let me just put in another one here. Running 9 and 18. We'll do that a different color completely. Yeah, we're just looking at that, doing all that and stuff, and you know how that shows up at order flow. Let me just remove this one, so just to make it like a little bit easier for you on there as we do that. Let's just take that off. So if we look at utilizing, I'm just going to take these off just to make it a couple a little bit easier for you. What you can utilize is on a daily chart, okay, on a daily chart, a 9 and 18 EMA moving averages as a simple indicator of order flow. So in this particular case, what we can see here is, you know, we had a you know, in this, for this month, we have the 9 beneath the 18, and not unsurprisingly, we had order flow. You know, it was bearish until it changes, it crossed, and then basically you can see we've had the 9 above the 18, and that's an indication of, let's say, bullish order flow. And we might be about to get across, we might be, but you don't take, you know, you wait until it has crossed. Okay, you don't try and thump the gun. So as a very, very simple indicator of order flow, on the daily chart, the 9 and the 18 exponential moving average is an easy way for you to be able to work that, to do that. Okay, so that's what I would suggest there on that. It's a good question, Bill. Thank you for that. But you know, what we're interested in is also looking, as I said, gold has been operated as a safe haven there, and it has increased in price as markets have, you know, as traders and investors have been worried and concerned about state of global economy, and in particular in the state of banking sector. Not unsurprisingly, we saw a real rush and a real strong rally up there towards $2,000. So that is, as I said, that is one way, and that's giving us one indication there of effectively the market in a kind of a risk off mode. You know, when we see gold being strong, it's because, you know, people's risk tolerances, you know, is a little bit different, and, you know, so invariably it piles into that area there. What we also said is, you know, we looked at Swiss franc. Okay, Swiss franc can be. Here we go. I'm just going to put this onto the weekly chart. The Swiss franc, right, is an indication of, you know, the kind of that, whether we're in a risk on or risk off, or whether we're looking at safe haven. What we've seen here is that, you know, this is the US dollar against the Swiss franc, and last year we had, you know, last year was quite this is a weekly chart, it was a kind of a block there. There's a bit of a battle going on there, but once that battle came out, what we've seen that there's been, you know, when that has been in a strong downturn, what that's showing us is that there's a US dollar weakness and a Swiss franc strength. And so if the Swiss franc strength, and as I said, you know, I have my own models that I utilize. Swiss franc is, you know, the sort of top, you know, it's the strongest of the major currencies at the moment, and that in itself gives you an indication that, you know, we are operating in let's say a risk-off environment. Is that, you know, there is money flowing into that because there's people worried about and concerned about the state of the global market. Ian asked, do those same EMAs reflect more accurate order flows and lower time frame charts? Yes, you could utilize that, Ian, you know, if you wish to, if you're more of an intraday trader. But I think even if you're just able to identify order flow on the daily chart, even if you're in, you know, a lower, let's say you tend to operate on lower time frames, what you can see is that if you just have that overall indication, that in itself can help you a great deal. Okay, so you could utilize it to do that, but as a general rule, I say, you know, even if you just understand the daily order flow, that puts you in a great place, whether you be a swing trader, whether you're an intraday trader, etc. You know, because you want to be, even if you're an intraday trader, preferably you'd be looking to sort of trade in line with that. Okay, when your lower order time frame sort of sets up with that. So good question again. I hope that helps you. But yeah, as I was saying, Swiss franc there, that is giving us a reflection and implication that there is a risk-off mentality going on there, that there is invariably been seen that, you know, Swiss franc is very strong, and as I said, all of these elements are working to effectively give us that indication. along with that, okay, giving us a indication. Remember, we said like Japanese yen. Okay, Japanese yen can be seen as that. And then if we look at, here we go. If we look at this is the weekly chart of the US dollar against the Japanese yen. And what we saw last year, you can see that was quite some significant trend there on the US dollar, on the Japanese yen, on the weekly chart, and that was an implication that we know at that particular time. There was a lot of reasons, people sort of seeing that we were coming out of the post COVID lockdowns. We were coming out of the kind of post COVID supply side shocks, and also just an indication of the sort of strength that was being seen re-emerging in that US economy. So invariably what we saw was that people were very positive, people were very upbeat, and so we saw Japanese yen being very weak because they were in a risk-on mentality. But as we saw at the end of last year, that topped out, and we can see that for the most part we've actually been in sort of a downtrend where invariably we've had dollar weakness and some Japanese yen strength. And that is, a factor of people sort of starting to their growing concerns regarding their growing concerns regarding the overall state of the global markets, and effectively, as we saw, interest rates being risen around the world. Okay, around the world, both not in the US but in the West as well, for the most part. That has an implication on people worrying about that, whether that tightening has an impact overall on markets. Okay, and the effect that has on. So yeah, you're very welcome, Ian says thanks. Yeah, you're very welcome. Hope that's helped you a good deal. And so keeping an indication of whether there is strength coming into the Japanese yen. Okay, as I said, along with the Swiss franc, that gives us an indication of whether we are in a particular risk on or risk off environment. What we can also see with that is there's a couple of other things we can use. Is that if I look at the oil situation, okay, this is West Texas, and let's just change the colours on this just to give us a bit of a change to reflect and understand. So I'm going to have a bear candle as black as well. Okay, just reflecting oil. So what we had here, this is the weekly chart here. Let me just bring up, and what we saw was this was here, this spike higher was all when we saw the start of the war in Ukraine and the issues that was going to have on overall energy prices. Okay, we fell away from it, and then we had another part. But actually, then what we've seen is that that there's invariably that oil price from having reached those kind of highs up here around about, it was about $120, $130 even. We've drifted our way down, right down to sub $70, and we've had a little bit of a bump in the last few weeks. A lot of that was just due to the OPEC cuts to effectively basically prop up the price, because they had seen almost like a halving in price over a sort of a 10-month period. Now, in what way does that impact us in terms of safe havens? Or nobody would really necessarily see oil as a safe haven asset, but what it does do is it gives us a reflection of the state of the global economy. If the global economy is likely to be contracting, well then invariably there is going to be less demand for oil, and that invariably has an impact on the sort of lower price for oil, and that's what we've seen there over the last 10 months. So the last 10 months, 12 months is as people as analysts and traders and investors have come to the conclusion that invariably, the inflation, has been running riot, which means that interest rates have risen. And you can debate all you want about whether they've risen enough or whether they will continue to rise. That's another debate in itself. But that has had an impact on people's views in terms of the sort of state of the global economy and the demand that will bring. And that demand will, of course, as I said, have an impact on the price of oil, and hence why being able to sort of see that drift down, that was just another indication that basically, people's view of the future of the economy wasn't as bright as it was, sort of 12 to 18 months ago, and hence why OPEC had to make a difference to cut production, all right, and in order to effectively, to basically stifle supply in an effort to increase demand. And that did have an immediate impact, but whether it will continue to will depend upon the sentiment, okay, analysts and then traders and investors' sentiment about the overall state of the global economy. So by having it here, as I said, on a row profile, I can quickly just get a view and an idea of what have been the order flows into safe havens. All right, if funds are flowing into safe havens, well, then invariably that's giving us an indication of what the overall picture is, or what the risk sentiment is, and by trying to understand that can help us enormously. The interesting, curious element that we have at the moment is that we have here, I have a chart here of the VIX. The VIX is, it's the indication of the put and call options, okay, on the US markets, all right, and by doing so, gives us an indication of the state and the volatility that goes on within the US market, and in fact by that, be used as a proxy for overall global markets themselves. And what we can see here is that, in a very simple usage, just looking even on a daily chart, is that at the moment that's trading around about 1940 there, okay, for today's price. What does that mean if you're a complete new trader? Well, generally, what we're expecting is in let's say the old days, and I'll probably show you my age. So if I just go to maybe the monthly chart here, is that what we'd normally expect is in kind of, let's say, older days, once the VIX was trading above 20, that was an indication that markets were volatile, which meant that there was invariably something not great going on. Maybe there was whatever, there was it's a relationship between fear and greed, and let's say fear was building, and and invariably that would lead to elements of volatility and instability in markets. And so I'm just going to draw these on here. But as markets have become more, let's say, more dynamic, and have had a greater increases in terms of their the way traders have operated in them. Let's just turn this into a different color. That has changed that kind of relationship. So invariably, whilst 20 is still a kind of it's still kind of a bit of a threshold number. Now we also basically look more at numbers like 25 and 30. Namely, if we see prices above there on the VIX, a great deal for a consistent length of time, well, then that starts to worry us a bit here. So I'm just drawing these in on these charts for us so that we can have them. So if we look at if I look at, let's say this is the monthly chart, but let's actually maybe go down to the weekly chart. For last year, there we go. What I've got here, let's just bring this off here, is bang. You can see here, during 2020, this was the COVID crash, and you can see that the VIX itself traded up, wildly high there, didn't it? Okay, wildly high, because invariably they traded up as close as 80 because, people were terrified. There was, the global pandemic was kicking in. It was having an impact on markets. Markets are collapsing, and that, the fear was rife. Okay, the fear was rife there. We can see that. But then, as the world didn't end, as the world continued to turn, we saw that the VIX started to work its way down, and actually we in what was effectively just over a year later, we were back trading sub 20. With sub 20, I would look at that as that there's people are being more greedy and complacent than anything else. But then once again, as we start to go into the Ukraine crisis, last year, prices traded up again, and once again we were trading up above 30, and that's when fear was rife, so to speak. And you can see that it topped there a few times last year, okay, when the particular issues went in place, but then we drifted away down. And now we've had a couple of weeks where we had the banking crisis, all right, and it pushed us up above 25, but we've come back down again, all right. My own view, and this is a personal view here, is that I'm not convinced that the VIX is a true reflection at the moment for whatever reason. And I think that probably options operators are probably a savvier understanding of it than my own myself. But at the moment, that is effectively is a case of we're trading beneath 20, and so people are being more complacent than fearful in in equities markets, okay? But as I said, I'm not entirely convinced that that is a true reflection of the market state. But for traders, new traders, it's a simple way to get an idea, okay? If we're trading beneath 20, well, their markets are, are in a supposed happy place. But once we get and start trading above 20, and especially above 25 and 30, well, that's an indication that, there is, that, volatility is rife, fear is probably rife, okay? Markets are taking down things, and we will see order flows more towards safe havens. So, VIX trading above 25 and above 30, what you're likely to see is increased order flow across to the sort of, those safe havens, okay? Safe havens of being things like gold, things like Swiss franc, things like Japanese yen, things like, treasury bills. And that treasury bills, it might have an impact on the dollar index, which I also have here on my RoRo profile, okay? The sort of the kind of a dollar, the dollar index there, namely, let's just bring that up onto that weekly chart. His name is that what we can quite often see is that sometimes during times of real stress is that, as I said, people will look to buy American treasury bills, American government bills. But if you are effectively, if you're a foreign entity, looking to buy treasury bills, and you don't have the facility to do so in your own country, well, then, you're going to have to find a way to structure a deal to be able to trade it, to basically take those treasury bills, which means, you need to buy them in US dollars, which means you need to have US dollars, which means if you don't have them, you'll need to buy them. And that can sometimes lead to early demand for the US dollar itself. And so keeping an eye on the dollar index chart, which is here, here on the ActivTrades platforms, that can be a way to basically also, as I said, give you a little bit of an early warning signal. So what I normally suggest to traders then is that set yourself up a RoRo profile, a risk on, risk off profile, and I'll do a specific session on risk on, risk off in the next couple of weeks. I'll add it to maybe the sort of the June elements, so we can go into that specifically. But in terms of there we've got quite a few of the safe haven assets, and as you can see, the price action flowing in towards risk off assets, things like Japanese yen, Swiss franc, gold, etc. That in itself can help give you an idea of the overall sentiment in the market. And equally on the flip side, when you see money flowing out, all right, when it's flowing out of gold, when it's flowing out of Swiss franc, it's flowing out of Japanese yen, all right, that in itself will also basically give you an indication that kind of risk profile has changed, and you might want to work with that, okay, in terms of being able to build a trade plan around that. So there you go, ladies and gentlemen. We'll kind of run out of time a little bit. As they always say, time flies when you're having fun. I hope that you found that useful. I hope that's given you just a little bit of an introduction, a little bit of insight into the what are safe haven assets and how they're doing, and then also how you can utilize the ActivTrades platform in order to be able to sort of build a little risk on, risk off profile, so that you can get an idea of seeing where the order flows are going, but also B, how you can perhaps turn those kind of order flows from a threat into an opportunity. I wish you all the very best of success in your own trading endeavors, ladies and gentlemen. As I said, we'll be back on the 15th of May. Okay, 2 Mondays off here with the bank holidays in the UK. But we're back on the 15th. We're looking to trade the fail to return setup. So I'll be sharing with you how you can utilize that trade setup. And I look forward to seeing you then. Until such time, trade well, everybody. Cheers.